What's up, everyone? It's Caddy with Money Vesting. So in this video, I wanted to talk a little bit about equity risk premiums because there was questions on my previous videos, and I wanted to explain exactly the concept behind equity risk premium, talk a little bit about the trade-offs between risk and reward when it comes to investing in equities versus investing in bonds. So I hope you guys enjoy this video, and this will be a little bit educational slash update and analysis on the market. So I hope you guys enjoy it, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel, and also the link to our Discord and Patreon is going to be down below if you're interested in joining us. There is a 16% discount that is available till the end of this month, so in about 4 to 5 days that will expire, so links are going to be down below. Now, Liz Young pretty much tweeted 21 hours ago, the S&P 500 equity risk premium is at its lowest level since mid-2007. And when you're getting less compensation for taking on risk, it's a good time to be choosy, or in other words, to be selective. And this is the chart that she pretty much shared that goes over the S&P 500 equity risk premium and how it's been coming down. At one point, it was at way over 6-7% back in 2012, 2013. And even during the COVID times, 2020, it got up to as much as 6%. And since then, it has been nothing but trending lower. It's been coming down because of two things. The bond market absolutely been roaring. So the bond yields have been skyrocketing. The 10-year yields, the 2-year, the 20, the 30. And the earnings per share expectations, especially the earnings yield on a forward basis, has been trending lower because of the potential risks related to a recession and, of course, high inflation. So I'm going to first talk a little bit about what equity risk premium is and how it actually affects market returns. And then we'll talk a little bit about what Aswad Damodaran, Professor Damodaran, pretty much talked about early February in terms of his prediction of the index levels based on whether we see a recession or not, and what the earnings per share kind of looks like, and what that S&P 500 index level is going to be. So in very, very simple terms, equity risk premium comes down to the premium or the additional return that you can expect to make on top of the next best safe risk-free investment. So let me just put it another way. The equity risk premium is the additional premium, in other words, the additional return that you're making against the risk-free rate, which is in this case and always, almost all the cases, we use the 10-year treasury yield. We use the 10-year rate, 10-year treasury yield rate. And the reason is because the 10-year treasury yield is backed by the US government, and the chances of losing money investing in a 10-year treasury yield is next to none because it's backed by the US government. So you're pretty much almost always make back your principal and the coupon payments that you would receive by investing in a US treasury. And because the risk level is so low, that's why it's called risk-free, because it's a very safe investment. So the equity risk premium is simply the return you would get on top of the risk-free rate. So in theoretical terms, now in actual practicality, these are not exactly correct. Like, obviously the numbers are very chaotic. They can swing in these different ranges. But theoretically, if this number is positive, it makes sense for you to take a risk, right? It makes sense why you would want to invest in equities. But if this number is negative, it would never make sense for you to be investing in equities. And that's another thing that I want to touch on very briefly is that when we talk about smart money, right, when we talk about big money, where we're talking about hedge funds and institutional investors, one thing that I want you guys to always remember is that they always think in terms of risk and reward, right? Because they're dealing with hundreds of millions of dollars, if not billions of dollars, and they're investing in the markets, right? They've got a big responsibility on their shoulders. So they're always thinking in terms of risk and reward. They're not going after the highest return possible investment, right? Because they know the higher you go in the risk curve, yes, you can generate a lot of returns, but you will be taking on an enormous amount of risk, right? So to some degree, risk and reward are positively correlated, right? So the more return you want, the higher risk you're going to have to take. So they understand that, right? And they're always thinking in terms of risk and reward. So coming back to our chart here, and let me just go over my Excel spreadsheet to kind of give you a little bit more of a example type scenario. So let's just say that the earnings per share for the S&P 500 for the next 12 months, so EPS NTM, which is next 12 months, is $220, okay? The S&P 500 right now trading at just under 4,000, so 3,996. This is not a dollar amount. just 3,996 points. So the actual PE multiple, which is over here, is 18.16, right? We're simply taking the earnings per share, which is the next 12 months, and then dividing it by the S&P 500, and we're getting at 18.16, right? That's the current price to earnings multiple. Now, for those of you who don't know, a little bit of a tip. The reciprocal of this 18.16 is indeed the earnings yield, earnings per share yield for that particular index or ETF or whatever stock you're looking at. So all we're going to do is 1 divided by this number, and we get 5.51%. Another way to calculate this is simply taking into account $220, which is the earnings per share of the S&P 500, expected earnings per share for the next 12 months, and then dividing it by the S&P 500 itself, you'll get the same number, 5.51%. So you can do it both ways. You can take the reciprocal of the price or earnings multiple, or you can simply take the earnings per share, divide that by the S&P 500, and you get an earnings yield. It's called an earnings yield. Now, this is the earnings yield, right? I'm just going to highlight that very quickly. So this is the earnings yield. All right, 1 second. Over here, right? And then we got the 10-year yield, which is what you are getting by investing in a U.S. Treasury bond, right? That's the 10-year bond backed by the U.S. government, right? This is the risk-free rate, the 10-year yield. That's 3.99% as of right now. Like, so if you go over to the 10-year yield, these are all the 10-year yield, all the yields. The 10-year yield right now is sitting at 3.943%. So let's just, if you want to be more precise, 3.943%. So the equity risk premium right now would be sitting at 1.56%. What does that mean? That simply means this is the return. This is the additional return that you would be getting or you would expect to get if you simply invest in equities versus investing in bonds, right? So if you simply choose to invest in equities, this is the premium that you're getting on top of the risk-free rate for taking on that risk, right? That's your risk premium for investing in equities. If you simply invest in risk-free rate, the 10-year yield, you can make about 4%. Excuse me. But that's really the whole idea. Now, what happens if this equity risk premium starts declining? And that's exactly what we have seen in this chart. Hold on 1 second. Sorry guys, I've been under the weather, just been coughing a lot, and just, it's been brutal. But back to the topic here. So what happens if this continues to drop, right? What happens if the equity risk premium continues to suffer a blow and continues to deteriorate? Well, there's a couple different ways that can happen, and we'll go over what the consequences are. Number one, if the 10-year yields keep pushing higher. Now think about that for a second, right? If we come over to the 10-year yields over here, the US 10Y, and you notice how much it's already pushed up. Like, just for example, like in 2020, this was at 0.5%, 0.5%. If you plug that number in over here, 0.5%, look at your ERP, 5%, right? Your equity risk premium jumps to 5%. What does that mean? That means investors are going to be rewarded for investing in equities. You have an incentive to invest in equities. But if the 10-year yield is sitting at 3.943%, your equity risk premium drops from 5% to 1.56%. And that's what this chart over here represents, how much of a decline we've seen in equity risk premium. Now, at one point during 2000s, early 2000s, and in 1987, 1988, we did see this equity risk premium turn negative, right? So this actually was below 0%. And how would that happen? That would happen simply if the earnings yield was a lot lower and the 10-year yield was higher than the earnings yield itself, right? So expected market returns were a lot lower than the actual risk-free rate. So if, for example, let's just do 150 over here, earnings per share for the next 12 months, we get an earnings yield of 3.75%, and the 10-year yield continues to rally here and gets up to 4.25%. Now we're sitting at an ERP or an earnings, equity risk premium sitting at negative 0.5%. Absolutely crazy. If you think about it, now it's negative. There is no incentive for people to invest in the market. Why would you invest in something that's yielding you 3.75% when you can guaranteed get 4.25% annualized? Investing in the risk-free rate, which is the 10-year yield. That is the concept of equity risk premium. It's basically the premium or the additional return that you are making on top of the risk-free rate, which is backed by the US government. So it only makes sense for us as investors to be investing in equities if that equity risk premium is positive. The moment it turns negative, our incentive goes away, right? Our incentive absolutely goes away. And this is just on a more aggregate basis, right? This is more of the S&P 500. When we're talking about individual stocks, the equity risk premiums are much higher because their earnings yield, their stock market potential returns, their individual stock returns are expected to be much higher than that of 6%, right? 6% is the aggregate market. Obviously, that's a lot lower. But investing in individual stocks, the equity risk premiums are much higher because of the higher earnings growth, because of higher expected individual stock returns. There's a bunch of different reasons why the equity risk premium would be higher. But the moment it turns negative, or at least comes down to almost 0%, close to 0%, our incentive starts to dwindle, right? Our incentive starts to go away because rational investors then will flock over to bonds because it's a much better, safer investment, and you can get the same amount of return, if not more, for literally no risk. So that's the whole concept that I wanted to go over. And again, you can see how the bond markets have really rallied, and even in recent times here over the last few weeks, you can see the bond market, the 10-year yield especially, has seen 4 consecutive weeks of green. So this right here has been just a massive rally from 3.3% over to now almost 4%. So we've seen the 10-year yields rally about 19% since the beginning of February. So just this month alone, we've seen the 10-year yield rally about 12%. That's why this concept or this idea of the equity risk premium is kind of resurfacing. So hopefully by now you have a really good understanding on what this actually means. And Professor Damodaran also tweeted back in February, a little bit earlier in February, that after a rocky 2022, markets found their footing in January of 2023, with the S&P 500 rising, 6%, the T-bond rate. He's taking the 20-year yield. We take the 10-year yield. So T-bond is the 20-year yield, which dropped to 3.52% and implied an equity risk premium on stocks declining to 5.54% from 5.94 to start the month. So we are seeing a bit of a decline in the equity risk premium. So it's becoming less favorable, and in other words, less of an incentive to be investing in the markets. And what he's actually using is not the earnings yield, but instead the expected return on stocks, which he's using at 9.06%. So all the math that he's doing here is 9.606% minus the actual the T-bond rate, which is 3.52%. So you'll probably end up at around 5.54 or in and around those levels for the equity risk premium, right? So simply doing the math here, 9.06, which is your expected stock market return, minus the T-bond rate, 3.52, and he ends up at 5.54. So you can see that right there in this analysis. So it's a little bit different. You can take the earnings yield, or you can take the expected stock market return. And for the risk-free rate, you can take the 10-year yield, or you can take the T-bond rate as Professor Damodaran's taken. But I personally take the earnings yield or the individual stock returns, and then I subtract that with the 10-year yield to arrive at my equity risk premium to better understand whether it's favorable or not favorable to be investing in stocks right now. Now, this right here is another analysis that he has put together, like a very good table. And this again is Professor Damodaran. And one of the things that I kind of lacking in this table here is a little bit of a mild recession. So only 2 scenarios that he forecast is no recession and a steep recession. So those are both, probable outcomes, but I think a much, more probable outcome would be like a mild recession. But what he's really talking about here is if there is no recession and inflation subsides to pre-pandemic levels, which is closer to the Fed's target at 2%, the index value will be at 4,300. So that's our most optimistic scenario, where the index gets up to 4,300. But if you go into a steep recession and inflation comes down to the pre-pandemic levels or the Fed's target at 2%, index in that scenario drops down to 3,587, right? Steep recession and inflation comes down. We come down to 3,500. Why? Because EPS drops, right? So EPS comes in 20% below analyst expectations. And this right here is going to be a scenario where inflation stays high, there is no recession, and in that scenario, we drop down to 3,762. And the worst case scenario would be a steep recession with higher inflation, because that's going to be the most brutal outcome, and the Federal Reserve will be in a dilemma whether to raise rates or not. And in that scenario, the index level drops down to 3,200, because in that example, it becomes less incentivized to be investing in markets, because the T-bond rate would be at 5%. And the earnings will be coming in 20% below analyst expectations because of the steep recession and lower consumer spend. And as a result, the equity risk premium will be close to 0 or pretty much negative in that scenario. So we'll be looking at a worst case scenario of 3,200. Now, I do, I would have preferred like a mild recession type situation where we don't really see a steep recession, but we also don't avoid a recession, but instead we see a mild recession and something that's going to be a little bit more of a stagflation type environment where inflation stays high, a little bit more elevated than the Fed's target, but not really at exuberant levels, but also not at close to the Fed's target, right? Close to 4 to 5%. And then also the economy going through a mild recession. In that example, I could see like 3,600 as being a reasonable level for the market, maybe even a little bit higher, close to 3,800 as being a reasonable level for the market. We're not that far off, but of course, if the earnings do decline more than 20%, then we are in for some interesting times for the market. So hope you guys enjoyed this video and found it helpful. The markets right now, futures are slightly lower, but let me know your thoughts on the equity risk premium and your thoughts on Professor Damodaran's table and what your expectations are moving forward from a more macroeconomic standpoint. As always, if you enjoyed this video, a little bit of education, a little bit of an update, make sure that you drop a like, subscribe, and the link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.